Hi, my name is Daywen. I'm a student of the Calmat MBA program. Today, I'm going to show you my final project of financial accounting. Two topics about bonds will be covered in this. The first topic is to analyze zero coupon bonds funds issued by JCPenney at the year 1981. First thing first, let's talk about what is bond. By definition, a bond is a certificate of debt that is issued by a government or a corporation in order to raise money. The issuer is required to pay a fixed amount annually until maturity and then a fixed sum to repay the principal. That's the definition. Now let's talk about what is zero coupon bond. By definition, a zero coupon bond is a bond bought at a price lower than its face value, with the face value repaid at the time of maturity. It does not make periodic interest payments or have so-called coupons, hence the term zero coupon bond. Now we know what's the traditional bond and the zero coupon bonds. Let's talk about what's the difference between them by item by item. Let's talk about the interest first. Traditional bond, the company they sold you bond, they will pay you the periodic interest. When the zero coupon bond, by the definition zero coupon, that being there's no interest paid to you to pay to investor. Let's talk about the risk. Since the traditional bond they pay you the interest every like half year or every year, so you got a lower risk. If any the default of the payment, you're going to lose everything. But with the zero coupon bond, you don't get any interest payment during before the time of the maturity. So if anything goes wrong with the company, the default of payment, you lose everything. And talk about the term, how the length of the bond. Normally traditional bond they got a shorter term, like 1 year, maybe couple months, 1 year, 2 years, 3 years, 5 years. Maybe some of them could be 30 years. When the zero coupon bond normally they got a longer term, like the 8 years, 10 years, or even longer. And let's talk about the price. Traditional bond, you need to pay the higher. Normally it's about the face value of the bond or very close to the face value. When the zero coupon bond, since the company don't pay you any interest in the regular time, so they give you a huge discount, or we call it deep discount, for the purchasing price. And let's talk about the last one, reinvest. The traditional bond, the company pays you interest every year, so the investor need to think about what do you want to do with your interest you earned. When the zero coupon bond, you know how much money you're going to get at the end of the period of time, but so you don't need to worry about anything before the day. It's time to let's discuss what the investor buy the JCPenney bonds with the zero coupon, and when they can, the same investor can put the same money on a different investment and get a 15% interest rate. The JCPenney has priced the $100 face value bond have the huge discount at 33 and 25 cents. That's equal to we base the calculation, and you can get the annual return rate for the whole 8 years will be the 14 and the 25% interest rate. It's a 14 and 1/4% return of the investment. Is a good investment or not? It's hard to say it's good or not, but you take a look at the picture, the graph, the chart here. You can see that almost the time the JCPenney issued the zero coupon bond is about 81. In the next about the 8 year, you can see the interest rate drop a lot, a huge drop. So if you buy the JCPenney, the coupon rate, basically you got the guarantee you they got a discount. You got an interest rate at 14-25%. When but if you put your same money on a different investment, they put it floating, so it could drop could be from like a 15 drop to 8% only. So I think the JCPenney the investment is a good choice. How much money did JCPenney really actually receive with the bond when they sold? For every $100 bond, face value bond, JCPenney actually received $33.25. Therefore, you can get a calculation by the 400 million times the 0.33%. 33%. You get actually the JCPenney get money get is 133 million only. Now it's topic number 2. It's a summary of the Business Week magazine published in 1998. There's a topic is it's time for bonds to get some respect. First of all, I have to quote from the Burton McCall. He said, "What was a poor investment over the past 60 years will not necessarily be one over the next 60." From year 1946 to recently, stock market average return rate is 7.5%. At the same time, bond market average return is only about 1%. Does that mean the stock market always be a better choice for investment? Of course, it's not true. I have to give you an example. Sometimes the bonds is a better choice than stock. You can check the table here. When we put 100% stock in 2008, you will lose the 30% of your investment. But when you put a 100% in bond, you will earn 26%. Of course, if you mix the stock and bond, you got the number between the two numbers. From the last example, now we know the stock not always perform better than bonds, especially when the stock run into the panic stage. Everyone want to get out of the stock and then put the money in a different market. At the moment, bonds is the best. And who should consider to invest on bonds? Actually, in my opinion, everyone should put some diverse their investment on between the cash, bonds, and the stock. Of course, there are dark side with bond. The biggest risk I can say for bonds is inflation, because the bonds are the based on the fixed rate of return for the time of period. Therefore, let's take example. If you purchase the bond, they pay you 3% for like 10 years, but during the 10 years, inflation is about 5%. Actually, what will you do? Actually, the bonds was the value was very low, and everyone want to get rid of the bond and want to buy yours. That being the bonds value, the price drop a lot. Thanks for spending 8 minutes with my presentation. Thank you, and welcome to join the Calmat.